Today, we will talk about distressed securities, meaning, overview and examples. Distressed securities are financial instruments issued by a company that is near to, or currently going through, bankruptcy. These financial instruments include common and preferred shares, bank debt, trade claims, and corporate bonds. A security can be considered distressed if it fails to maintain certain covenants, such as the ability to maintain a certain asset-to-liability ratio, or a particular credit rating. As a result of financial distress, the value of these securities is significantly reduced, but they can offer high-risk investors the potential for high returns. Distressed securities appeal to investors who are looking for a bargain and are willing to accept risk. Some investors believe the company's situation is not as bad as it looks, and they anticipate their investments will increase in value over time. Others may foresee the company going into bankruptcy, but are confident that there might be enough money upon liquidation to cover the securities they have purchased. However, it's important for investors to consider what happens in the case of bankruptcy, as equity is usually rendered worthless. Bank debt, trade claims, and bonds may yield some payout. Under Chapter 7 bankruptcy, the company will stop operations and go into liquidation, while under Chapter 11 bankruptcy, the business restructures and continues operations, potentially yielding profits from distressed securities. Securities are labeled as distressed when the company issuing them is unable to meet many of its financial obligations, often carrying a CCC or below credit rating. The anticipated rate of return on a distressed security is more than 1,000 basis points above the rate of return of a so-called risk-free asset, such as a U.S. Treasury bill or Treasury bond. For example, if the yield on a 5-year Treasury bond is 1%, a distressed corporate bond has a rate of return of 11% or higher. Here are 3 key takeaways. 1. Distressed securities are issued by a company near or going through bankruptcy with reduced value, attracting high-risk investors for the potential of high returns. 2. Investors should carefully consider the company's situation and potential bankruptcy outcomes before investing in distressed securities. 3. Anticipated rate of return on distressed securities is significantly higher than risk-free assets like Treasury bonds. Hope this would help. Thanks for watching.